Tonight, I just wanna take you.
Hey, what's up, everyone? Thank you for stopping by again. It is very good to see you. This is going to be another exciting, life-changing video about equipment and inventory. So we're going to give you 5 differences between the two. 1, 2, 3, 4, 5. 5 differences, okay? So we're going to talk about the differences between equipment versus inventory, and hopefully this helps you understand it better and how to categorize it on your books. And yeah, so let's go. So we're looking at number 1. The first difference is, okay, the first thing we're talking about is when you make that purchase, right? So you're going to purchase inventory and you're going to purchase equipment. Okay, so when you make those purchases, they're both obviously assets. Okay, they're going to be assets on your books, on your balance sheet. But for equipment, for equipment, that's going to go under machinery and equipment, because that's typically the account is called machinery and equipment. So it's going to go sit under that account under your under machinery and equipment. And for inventory, we're going to put that for the purposes of this video, we're just going to stick it in finished goods. Okay, of course, there's other inventory accounts like raw materials, work in process, and finished goods. But for now, we'll just say finished goods. Okay, make it easy for yourself. Make this an easier video. So that's 1. Okay, so now number 2. We are looking at how to categorize these purchases. Is it going to be a long-term asset or is it going to be a current asset? Long-term, the equipment mainly relates to it being a long-term asset. We're expecting to have, typically equipment purchases last longer than 1 year, so we're going to put that on the books as a long-term asset. For inventory purchases, that's going to go under current assets. Typically, an inventory lasts 1 year or less. Hopefully that's the case, because you don't want inventory sitting on your books for a long time. You know, it's going to be obsolete. You're losing money, and then you have to start testing your inventory for impairment. We'll talk about that in a little bit. Okay, so that is 2. So that basically was categorized. So how to categorize your purchases. Again, equipment is going to be a long-term asset on your balance sheet, and inventory will be your short-term asset on your balance sheet. Okay, so that's 2. Okay, so now we're looking at the purpose. Why did you buy this asset? What is it doing for your business? You have 2. It can do one of 2 things. If you buy equipment is helping you operate your business. Okay, so if I buy a piece of machinery for the business to like lift crates all around the warehouse, right? So that's helping me operate my business. So that's equipment. That's the differentiation of that's how to define equipment. These are purchases to operate your business. And for inventory is going to be what you're actually selling to the public, to the consumers. So you're purchasing these products for sale. Okay. If you're a tire factory, obviously your tires are going to be inventory, right? That's what's helping you generate your sales. That's the meat of your business. That's the main core of your sales, is selling tires. So that will be your inventory. So that's the definition of inventory. Okay, so I think that is 3. Now we're on 4. We're moving right along here. This ain't gonna take long. Okay, so we're on number 4 now, and this is how to amortize and how to value the assets that you purchase, right? So, and I should say amortize. Okay, I swear someone said to me one time, hammer time. How do you hammer time assets?
Stop. Hammer time. Go.
I think maybe I may have said it because I was talking too fast, and this whole time in the live lecture, they were thinking about hammer time. So I don't know if it was me or them, but anyway, yeah, you don't hammer time assets. I suppose if you own like a construction company or something like that, you hammer time is something, but amortize, okay? So for equipment, how you amortize equipment is you depreciate it typically on a monthly basis, and what's going to happen is at the month end, you're going to depreciate. You're going to, because it's just like as if you had a car. The car is going to depreciate, so you want to make sure your books are current and you're carrying the right value of the asset on your books, in this case the equipment. So you have to write it down, and how you do that is you depreciate on a monthly basis, and it goes into an account called depreciation expense on your income statement. Okay, so that's how you do equipment. That's how you amortize equipment. For inventory, now you don't really depreciate equipment. Basically when you sell the product, what you paid for that piece of inventory, now you're going to recognize that expense on your income statement, okay? Now, if you do at some point, I mentioned it earlier, if you have inventory sitting on your books for way too long and it's starting to become obsolete, it's not working anymore, maybe it's damaged, now you're losing money, right? So now what you have to do is something called tested for impairment. So that's what you would do, and it would be under some inventory reserve account, allowance for inventory account, where you write down the value of the inventory. Okay, so that is number 4. We're on the last one, folks. The last one is, I just talked about it briefly, but and it's basically, how are we going to amortize the equipment and the inventory? For the equipment, you're going to it's going to hit an account called depreciation expense on your income statement at month end. That's what we do as accountants. We close the books at month end. So if you're friends with an accountant, or your boyfriend or girlfriend is saying, "Look, honey, I can't hang out tonight because for the next week I'm in month end." So that basically means they're closing the books, and part of that closing of the books is depreciating the equipment and journalizing it into an account called depreciation expense. Now for inventory, when you sell the inventory, I already mentioned it, it goes to account on the P&L called the cost of goods sold, okay? And that's it. That was real quick, painless, quick and simple. And I hope it was helpful. That's all I got for today. 5 differences between depreciation and inventory. Of course there's more, but those are the ones I picked. Hopefully it helps. And yeah, so like the video down below, subscribe to the channel. And if you have any more questions, I also have my website is CelTaxServices.com, CelTaxServices.com. Visit me anytime. I'm here 24/7. Well, not really, but I'm just saying it to sound cool, but it's really business hours because the other times I'm asleep. I love my sleep. Okay, so anyways, good to be in front of your camera, your phone, whatever, and doing this little spiel on equipment versus inventory. Okay, thanks so much for stopping by and taking 7 minutes out of your life. Hopefully this changed your life, and now you can go walk the streets and talk about equipment and inventory and just sound like the coolest person in the world. Thank you so much, everyone. Business is better when your books are together. I'll talk to you soon. Bye.